Welcome to Looking at the Markets with David Modell. I wanted to talk about stop losses today. I've made videos about stop losses and where to place them, or where I personally place them. And I don't want to give the wrong impression, because you don't have to use stop losses, believe it or not. Yeah, okay, so let me read this to you, and I'll explain while I go along. I've heard some stock market gurus say that you must always set a stop loss order with your broker for every trade that you do. As usual, the gurus are wrong. If you use a small position size in your trade, then you don't need to set a stop loss order. Now, when I say use a small position size, I mean you're using 5% or less of your trading account on the trade. In fact, using less than 5% is even better. For example, you can use just 1% or 2%. If you use a small position size, then it's not the end of the world if you lose 100% on the trade. Think about it. Is it really any riskier to buy a $200 call option and not use a stop loss order compared to buying $2,000 worth of call options and setting a 10% stop loss order? It's not any riskier, because either way your maximum loss would be exactly the same, $200. When you buy a stock or option and use a small position size, you have a built-in stop loss, because 100% of your purchase is the most that you could possibly lose on the trade. It might sound drastic to lose 100% of your money on a trade, but it's not really drastic, since you're only risking a small amount of money. And there's a big advantage to using a small position size instead of using a larger position size with a stop loss order. The market will often give you head fakes, in which a stock will swing downward, triggering your stop loss order and causing you to take a loss, and then swing upward, causing you to regret exiting your position for a loss, because you could have stayed in the trade and made a nice profit. Instead, if you simply use a small position size and don't put in a stop loss order and just ride it out when the stock price swings downward, you could avoid getting head faked by the market. And I'd like to show you what that looks like in a chart here. This is a daily candlestick chart for Apple, and imagine if you bought here, right, and then you bought a call option or call option spread, or just bought the stock. Well, if you buy here, here's a head fake. The market swings downward, and if your stop loss is here, you would have gotten stopped out and you would have taken a loss on the trade. And you know what happens a lot of the time right after you get stopped out? The market goes right back up and up and up. And if you had just stayed in the trade, just ride it out, not only would you have broken even, but you would have made a nice profit. Here's another head fake on the same chart. If you had bought here, if you buy here, the market goes down. That's the head fake. And if you had gotten stopped out here, if you had set your stop loss here, you would have taken a loss. You would have lost money. But then what happens after the head fake a lot of the time? It goes up and up and up. And if you had just stayed in the trade and not set a stop loss, again, you could have made a nice profit here. Now, I'm not saying that this is a perfect method, because there's no such thing. I'm only saying that the market gurus out there are wrong, once again, when they claim that you absolutely must set a stop loss order with your broker whenever you place a trade. Alright, so I hope this was helpful, and I hope I showed you an alternative to the, common knowledge, supposed common knowledge of these stock market gurus out there. And I wanted to present you with an alternative to stop losses. I don't always use stop losses. In fact, a lot of the time I'll buy a call or a call spread, a small amount on the trade. I'll use a small position size and I'll just ride it out because I'm comfortable. I'm very comfortable with the amount of money that I'm risking on the trade. And so a stop loss is not always necessary if you set it up correctly. And if you'd like more help, you can email me, David Modell, at any time. My email address is davidmodell@gmail.com. If you like this video, if you found it helpful, please give it a thumbs up on YouTube and leave comments. Also, please subscribe to my YouTube channel if you haven't done that already, so you can receive the latest updates on my financial educational videos. Thank you so much for watching this. I appreciate it, and I'll talk to you soon.